Sorry
Hello.
about that.
Oh yeah, it's all good. Thank you so much for joining us. Thank you from here from San Francisco. Our final presenter is Mark Mordell and team. Actually, you're jumping around my screen, but you'll please introduce yourselves as you go along the presentation. This is a $2 billion asset bank in Silicon Valley, I believe, active in the venture capital space as well as some other interesting verticals. Just raised new capital from a lot of very well regarded bank investors. So I hope we can talk about that, the most recent capital raise. One of them, Henshi from MFP, just went on the board recently. And this is a unique, you're a unique, you're not a thrift conversion, put it that way. So,
no, we're not.
Forward to seeing your presentation. So I'm going to pull this up. I'm going to start sharing my screen. I just have to remember. Just give me 1 second. The one with the bridge, right?
That's the one.
Right.
Just as long as it's not the Mackinac Bridge in Detroit, it should be the Golden Gate.
The Golden Gate Bridge, right? Here we go. Okay, let me just make this take up the whole screen. Okay, very good. The floor is yours. Thank you.
Well, thank you, Julianne and Ian, for having us. We're looking forward to getting some feedback here. So if we can go to page 4, please, Julianne, if you're driving. As Julianne said, we're in excess of $2 billion. We're headquartered here in Silicon Valley. Have been for the last since 2003, and you know we started actually when we founded in 2003. We were the private bank of the peninsula, and you know we were based in Palo Alto at that time. I was not involved. I joined the board in 2006, and because the team was so dysfunctional, I ended up being chairman a year and a half later, which was interesting. And so we decided to get the best people we could at that point. And so when I joined the board, we were 100 million. We got through the financial crisis with a new CEO. We got to the other side of 2009, and we decided to raise capital, change the name, go de novo-esque, and start hiring the best people we possibly could. And that's when I took over as CEO. So fast forward, using our network and Ken Brenner's network, the previous CEO, we were able to just attract great people. So people were starting to get big bank counsel with small bank attention, and that made a difference because we clearly were able to attract the right team. So we have a very well balanced loan portfolio that we're going to talk about, and again, the team at the end. Everybody that's an influencer in this organization has anywhere from 25 to 40 years experience in the space that we're playing. We're positioned to grow. We have been growing. You're going to see some stats. We've increased our market presence and expertise. We have clearly defined lines of businesses that we're going to talk about next. And again, we have the right talent to execute. And we've been executing fairly well over the last 5 or 7 years. You can go to the next slide. So we really have 5 verticals in which we're competing. We have 3 more local conventional areas, as well as 2 areas that are less conventional and growing on a more national presence. We have commercial real estate. You know, it's a big driver in the Bay Area, clearly. It's our largest portfolio in excess of 400 million. It's the average loan size is small. It's probably $3 to $4 million tops. So it's very stratified, the most liquid portion of the market. You know, loan to values, you know, are rarely in excess of 60%. We're very, it's been a very solid business for us. Our corporate banking division is C&I. We have one of the best bankers, our chief banking officer, Doria Hamilton, is one of the best bankers in the Bay Area and has been for, you know, the better part of 30 years, if not more. That's our second largest portfolio. It's been a driver for us. It's, you know, we are high touch. We're a high touch organization. And this is what our, you know, one of our main value propositions is, because People, certainly in the C&I business, local C&I business, need to know who they're doing business with, and we provide access to everybody at all levels, from the RM to the chief banking officer to the C-suite. Construction lending is also a significant portion of our business. It's about a $250 million portfolio. We don't do any subdivisions. We do, our developers scrape typically 1 to 4 units and build new ones, and that's it in proven markets. It's a very disciplined formula that they utilize, and it's been working so much so that it was our largest portfolio in 2008 and 9, and we took not $1 loss in that portfolio. Specialty finance and venture lending. Specialty is everything that's non-C&I. We've been in that since 2008 and have really grown that portfolio over the last 4 years, and have gotten very focused in the areas in which we can compete and perform the best. So it's obviously a lot more controls in specialty finance, includes as it says, asset-based lending, invoice financing, M&A, finance, cash flow lending. It's a large portfolio for us. It's been performing quite well. It's management intensive, but it's worked very well for us. And then in 2018, we decided to get into the venture lending business. So what we did is we went out. Prior to that, we brought on a new board member, Mark Verissimo, who was the chief risk officer at Silicon Valley Bank for the last 24 years prior to his retirement. We raised capital prior to that, before we hired anybody to do this business. And then we created policy and governance inside our organization so we could attract one of the best, the right leadership, because we needed the right leadership in order to attract the right lenders. So we went out and there were 2 people that we focused on. We focused on our number one, and ended up getting our number one fella, Sam Baumick from PacWest, formerly Square One, and Silicon Valley Bank before that. That portfolio now is about $250 million in commitments, just under $100 million in outs, and $800 million in deposits over the last 3 years or so. So these 5 verticals really keep us pretty balanced, and is able, we keep adding them as we're able to grow, as our capital allows and our expertise allows. We don't want to dabble in anything. And so these verticals are really what are allowing us to grow at the extent that we are. So we can go to the next slide. So we're branch light, as in no branches. Technically, our headquarters here is a branch. We don't have any cash that we deal with. We have 2 LPOs, one in San Francisco and one in Redwood City. And then we have about 35 people or so working remotely. We have business development people in Boston, Connecticut, Arizona, Austin, LA. Pardon me? That's it. That's it. And so we're able to go to where the business is, because we are more geographic agnostic in our again, specialty and venture businesses. So we are positioned pretty well. We don't have a ton of office overhead. We obviously have a lot more hybrid and remote workers post-pandemic, but we have a significant of our portion of business in the Bay Area here, and then able to develop a more national presence in other product types. Next slide, please. And this is the, we talked about our growth. When you look at our total deposits, they've grown 23% over the last 5 years. When you look at net income, it's, net loans has been a 17% growth rate. Our deposits have had a 26% growth rate. And if you look at our net income from where we are going, we were up 55% from year to date from last year. So our strategy has been working, and we're getting to the scale where we have significant operating leverage, which is why our performance metrics are increasing to the extent they have been, and will continue to, because we are incredibly asset sensitive. to you, Pat.
Okay.
Yes. Pat, talk about some metrics.
Yeah, so I'll dig a little bit more into the financials. So just some second quarter highlights. It was a really strong quarter for us. We had record earnings of 76 cents per share, which you can see is pretty good growth year over year, and from previous quarter of an upper 20%. Return on assets is now expanding nicely. It's back over 1%, but it was down quite a bit from a lot of it was low rates, but also just the balance sheet growth that we saw and the growth in deposits and sitting in cash and returning nothing. Now that we put that cash to work at higher rates, that ROA is moving in the right direction for us. And as Mark talked about, really strong loan growth here. And then you can see our margins expanded nicely. It's up to 362 now, where you look at from last year, it was a 305. Again, it was higher rates and also better balance sheet mix that we have at this point. And then credit quality remains strong. No charge-offs this year. Non-performers are basically almost nothing. So flip to the next page. Just some more detail around our financials. If you look at the sort of the right-hand side, you can see some of the growth metrics we talked about, EPS growth, net income growth. And then if you look at pre-tax, pre-provision growth, pretty significant. And then I would flip down to the performance measures. You look at our efficiency ratio, how that's driven down. Now we're in the low 50s there. And then if you flip further down, capital, as was mentioned earlier, we did finish a capital raise. You can see our capital ratio has improved quite a bit on top of that. And then digging a little further in our loan portfolio, Mark kind of touched on some of this, the breakdown of our loan portfolio. A lot of it's in California. That is getting more diverse by the day. But, roughly 80, we have 85% here, but it changes by the day, obviously. But 85% of the portfolio is in California. And then below that, we'll talk quite a bit about venture here. As Mark mentioned, it's close to $800 million in deposits and just around a little over $100 million in loans in that business. And then I'd flip over to the chart on the right. You can see, as Mark talked about, 50% of our portfolio is between C&I and owner occupied. That's our focus, and that's where we expect to see the growth continue. And then further right to that, you can see the floating rate portfolio is, over 50% of our portfolio is floating rate. We've worked through all the floors at this point, and that is all prime based. So we're going to continue to benefit from each increase in the Fed funds rate. And then some charts on the bottom kind of break out our loan portfolio a little bit further. The left-hand side, our commercial C&I portfolio, and the right-hand side, our commercial real estate. So as Mark mentioned, it's a pretty diverse portfolio. And, credit quality, we talked about this already, pretty strong here. I don't think there's really much to highlight. This is probably not much different than most of the banks here. It remains pretty strong. The next page on the deposit, this is probably where most of the story is in the deposit portfolio. You can see the growth here that we've experienced over the last several years. Part of this is just a good growth in the overall franchise, but a big piece of this over the last three plus years is the growth in venture business. That's helped that expand quite a bit through year end. Seen a little bit of leveling off here this year from some of the venture portfolio and some of the other things, but obviously it's still pretty significant growth. So we've transformed a lot of this deposit base over the last few years, driving down that, loan to deposit ratio below 70%. It's, about 67% at this point. DDA is in the mid to high 40% of our deposits. And you can see on the far right or the bottom right, what's that done to our cost of deposits too? It's come down quite a bit. Obviously, you'll see that increase for the rest of the year, but you can see the nice decrease that we had. So this is definitely a good story for us here. And then balance sheet liquidity, here's a little bit more detail around that. You can see the loan to deposit ratio. It's been hanging around the low 60s. You may see that tick up a little bit, but it's obviously liquidity is in a pretty strong position for us. And you can see on the bottom left that that's allowed us to grow the investment portfolio over the last few years. It still allows us to have a pretty good liquidity position. Most of the portfolio is in, mortgage back. We did start to buy some municipal bonds and held to maturity portfolio along with that. But it's a pretty liquid, high quality portfolio. And here you can see the margin, a little more detail around the last few quarters, how it kind of bottomed out late last year with the growth in deposits and all the cash that we had. And now with the higher rates, that margin expanded nicely. And it's more importantly, on the right-hand side, the growth we've seen in net interest income. And next is on the efficiency ratio. you can see here, it's moving down nicely. You know, we've obviously we've been investing in the bank with hiring new bankers and the support staff to support that growth. But we've been able to obviously outpace revenue. Revenue growth has been able to outpace that to get that efficiency ratio down to the low 50s here at this point. So with that, Mark, I'll turn back over to you.
Yeah, and I did forget to introduce who we have here. We will go through just so you can see some of the experience, but I forgot to introduce my associates here. We have Gina Petersons, our Chief Operating Officer, and Pat is our Chief Financial Officer. When you look at who we have in the C-suite now, as I told our management team, this is the first time since I've been sitting in the chair that that we don't have any work to do in the C-suite right now, which is really great. So having the addition of Pat and Gina has been invaluable for where we're going. And when you look at the amount of experience that everybody has here, everybody on that page has, again, 30 plus years experience in the space. And so it's nice to have a team that strong. And it continues on through our division managers. If we go to the next slide. Again, Sam Baumick leads our venture lending group. He's been in the business for 30 plus years. Mark Cameron runs our structured finance, our sponsored finance group. Specialty finance group, too many S's. He's been with us for almost 3 years now as well. You can see the pedigrees of where they've been beforehand. Joe Maletti runs our CRE division. And again, he's been in the space for another 30 years. And Fergal O'Boyle has been running our construction lending division since 2008. So we have the team, we have the contacts, we have the experience and the credibility in the marketplace. And the way we've been able to grow over the last few years, or last 10 years, I should say, is through the people that we're hiring. Because, just take venture lending, for example. Venture lending community didn't know who Avidbank was until we get somebody like Sam, and we go through, make a business plan together before we hire him, understand where his hot points are, what he has to do, and does it fit in with our credit appetite? And to make sure that Sam's not out there doing deals that he can't do or we won't fund, because that just makes, he loses credibility, as does our organization. And so that's our most recent ad. The same thing with Dory Hamilton, our Chief Banking Officer, and who leads our C&I division. Again, we traded on her coattails until Avid became relevant to the market, which is, I think, where we are today. So this, as we all know, this business is about the people. It's about execution, and we do our best to find the best talent we possibly can. And now, post-COVID or almost post-COVID, we can cast even a wider net, since more people are open to this more hybrid or remote environments, which for a complex company like ours, that wider net goes a long way, as opposed to just fishing in your backyard. So I've always found that we can talk at people for hours, and what's most important is what's on their mind, and so, or on your mind in this case. So at this point, we wanted to give you a 10, 15-minute overview, so there will be time for questions, because for people that don't know us that well, there seems to be a fair amount of questions, because when you look at a $2.5 billion bank, you won't see many that look like this.
No, that's true. Yeah, thank you, Mark, and thank you, team. It was really nice to meet you, and Patrick, it's nice to see you again. Yes. On the West Coast. Yeah, I have a few questions too, but let's just get started with the questions that have been submitted. So Warren Mackey was asking, Mark, how did you get involved? Why did you get involved with the bank in the first place in 2006? It's only 100 million in assets. That's under the radar.
So it's under the rug. The radar is not even focused down there.
Right.
I've always used these small banks. I was in real estate business beforehand, had a fund. We were about, at our top point, we were managing in excess of 1 million square feet and a value add type situation. So I use these small banks, big fish, big fish, small pond kind of concept. So invested in them as well. I saw that the private bank of the Peninsula came across my desk. And I passed on that investment because it didn't just look like a me too of another community bank and waiting for those guys to get purchased. So I've always done other things as well, along with my real estate business, value add to companies, taking some over, value add and liquidating them. And so the private bank approached me to be on the board, and they wanted my business primarily because I was banking at another small bank. And I joined the board, and there were, I tell the story, the very first meeting that I attended, we had Gary Finley, who's a bank guru here on the West Coast or for California banks. And Gary came to our board meeting and kind of showed where we were of the class of 2003. There were 17 banks in 2003 that were created. And we were number 17 in everything, meaning we weren't growing, we weren't profitable, we weren't doing anything that we should be doing. And you know, I'm a competitive guy, and I know Pat and Gina are competitive as well. We'd like to be number one. You know, we don't have to be number one, but we like to be number one, but being last is not it. And so I ended up just getting more involved, and I ended up being chairman 18 months later, and then still ran my business, ran the bank basically as the CEO. And then in 2011, we went on we're starting to go on a search for a new CEO since the bank outgrew Cat. And they approached me and said, why don't you just do it? You've been doing it anyhow. So I outsourced my management. I only signed leases and sale docs. That was it. Didn't do any new deals since then. And I took over as CEO in 2012. We changed the name, and we were about 300 million then, and now we're 2.1 billion, call it at this point. And it's all been organic, and it's through the people that we've been able to attract.
Wow. Okay. Yeah. Very, very impressive. Warren also has another question that was my question as well. Warren was asking about future capital raises, but just to, before you talk about the future, can you just remind us of the past? Can you tell us of the past capital raises, what prices those were at? And then the most recent one, I think, had some marquee bank investors. If you could, you know, tell if that's public, if you can tell us who invested in that round, and then talk about future capital.
Well, the first round went on was a year after I joined as CEO in 2013. And that was, you know, obviously post-financial crisis when there were mostly recaps happening, and we weren't a recap at that time. That's when we decided to pay off TARP so we can start to hire the people that we needed to hire. And so we had it was not a slam dunk, first-time CEO, not well known, primarily real estate and a little C&I at that time. And so we got some pretty good investors back then. I mean, we had EJF and bank funds and Manulife. And so we raised 16 million in 2013 at 975, which was just a slight discount to book, which seemed like a bargain back then, given where things were going out in private raises. In 2017, we raised $20 million at $19 a share. And we did add some more investors in at that point. We added, Wellington, Endeavor, Patriot, and some other folks. So that was a slam dunk one, if you will. We were 5 times subscribed in 2 days. So, and it's because we stay really close with our investors. One, they like the story, and a lot of the investors that we do talk to want to know how to get in, since we're just raising this capital on private placement basis. Then we did a capital raise earlier this year, as you mentioned, Julianne. We raised $28.5 million. We priced it at $22.50. We expected to go out at closer to 25. Of course, bank stocks were sliding since the beginning of the year. So, and that was more of a rights type offering. We didn't, because the pricing wasn't great, because we had a lot of support from our investors, we went to our existing investors and allowed them to kind of keep their position. And if somebody didn't participate, we would reallocate the best we could. And then the bank and management or the board and management participated in every one of these offerings to a meaningful number.
Okay, great. Yeah, rings like Silicon Valley.
Yeah.
So
I like to take the good parts of that, not the other parts of that.
Right, that's right. When you talk about future capital raises, how do you feel now about you just listed, right? Or
no, we're not listed. We've been
listed.
In the pinks.
Okay, I apologize, but now there's more liquidity. I just was curious. Yeah,
we've been in the pink since inception. Our goal is to access the public markets because we think our stock is undervalued and always has been versus our peers, it seems. And so the only way that we can see to unlock some of that value is to access the public markets, the actual public markets. So we've been gearing up for this for a long period of time, hence rounding out the C-suite, building the finance team that can get us there, that has the experience. And so I think if we continue to execute as we have, the next capital raise would likely be a capital accessing the public markets. So we're accreting capital at a greater rate than we ever have, due to our bigger balance sheet and our asset sensitivity at the same time. So, opening venture lending when we did, having that excess liquidity with the dropping in rates, in 2020, that blind mice found some cheese there because that excess liquidity that we had to enhance our asset sensitivity has been just a winner for us. So, our capital ratios are not stellar, and we did that on purpose, not to raise too much capital at we didn't think it was a great price. Execute further, access the public markets, and hopefully get some better footing.
Okay, well, you'll have a good shareholder or potential shareholder list from this, so make sure you let us all know.
You bet.
Let's see, we had a question about expecting continued growth in venture lending, and let me just summarize. Roughly 70% of your portfolio is in the more commercial, more traditional local verticals, and then 30% are in those last two nationwide verticals. Is that
probably not that great? It's probably something closer to an 80-20 split, but close enough.
Okay, 80-20. But is that 20% part growing at much faster rate than the 80%? Well,
there's no question that the transactional business is growing. That's one of the great things about we are high touch and relationship based, but the value add deals go on no matter what happens. I think when you look at where the growth is coming from at this point, C&I is not happening as much. The only thing that really moves the needle is the owner occupied product. We have about 85 lines of credit that have zero balances in our C&I portfolio due to the fact of the liquidity that's been out there. And that's a geographic breakout, Julianne, in terms of the 80-20. So in that 80%, there is venture lending and other non-geographical confined product that's out there. So the growth that we're experiencing is certainly coming from specialty finance because that is more transactional. Certainly venture lending, that's happening. Those aren't great for outs, as it's more of a deposit play than it is an earning asset play. So those two and our construction business is another transactional type of business. So real estate and C&I are going to have the tougher time, in my opinion, growing in these more tumultuous times in a higher interest rate environment.
Okay, great. And so just to answer that, you do expect continued growth in venture lending. That was the specific question.
Oh, sorry about that.
Oh, no, I just wanted the answer is yes, right? It's
we do expect it, but it's not going to be the same as it has been. I think one of the, when you looked at our balance sheet last year, our fourth quarter, we raised in 21, we had about a $450 million increase in deposits in Q4 last year. And that was because there's some big transactions, big fundings. We're seeing the deals we're doing now, smaller fundings, because they're really concerned about how they're looking at some of their portfolio companies that is A, B, or C company, how, there's plenty of liquidity and powder that's out there, but I think the VCs are looking at it a little differently and being a little more concerning about how they're funding these companies. Instead of 2 years worth of runway, with a $50 million round, maybe it's 18 months with a $30 million round of financing. So there's no question they're looking at it a little differently than they did 18 months ago.
Okay. Okay. And then we had a question about the securities portfolio. I want to read you the specific question, but just real quick before I do, if investors or anyone interested would like to look at the chat and look at the at a glance, you'll see that Avidbank is a good case study for these AOCI marks, right? If we dismiss the AOCI marks, or if we don't take those marks just in the last 2 quarters, you flip from trading at a premium, at a 20% premium to tangible book, to a discount to tangible books. It makes quite a difference. And your capital ratio similarly could go from less than 7%, 6.9% up to almost 8.6%. So it's a big, this is one where it makes a big difference. And so the question was that the securities are mainly in RMBS, it's residential mortgage-backed securities with long maturities, maybe even getting longer. Do you expect to hold these through maturity, or given your growth opportunities and your need for capital, is there any chance that you sell them early to fund another initiative?
Well, so we've seen most of the duration extension now on these mortgage backs, right? These were 30-year mortgage backs, 15-year mortgage backs were purchased primarily last year, right? So I think we've seen the worst of it. Now it'll just be wherever interest rates move. We won't see an extension duration anymore. So we've had lots of conversations around this. And look, these are all government guaranteed bonds that are cash flowing and paying down, right? So we're continuing to receive cash flow off of these bonds. It's not worth taking the hit today of selling those securities for us. Look, we're very asset sensitive. We've been very asset sensitive. This is very strategic to purchase those in a low rate environment to add earning assets. And as rates continue to rise, you're seeing our profitability increase significantly. We'll offset some of that over time. This is pretty unusual to see such a big increase in rates over a short period of time. But we've seen the worst of that. Going forward, you should see us building equity significantly. And that OCI, unless rates move up significantly again, which I don't think they will, that'll come back down over time. So, we got to work through this over the next several quarters or next year or so. But it's not worth taking the hit today on us.
Okay. Well,
I think we're just going to have to be patient and work through it. And if interest rates do start to rise again, maybe there's some opportunity to take some liquidity, take some money off the table. And in hindsight, we probably should have been paying attention a little bit more to that. Towards the end of last year, as we saw that AOCI start to increase a little bit, but no one saw, I think, how the Fed has acted and telegraphing what they telegraphed. I think, in the first quarter of this year, we experienced a 400 basis point shock for a 75 basis point increase.
True, that's true. Ian, did you have any additional questions?
I didn't. Thank you for coming and participating. It's great to have you. It's a great story. Interesting round out to our day. Very different bank. People should pay attention. Thank you. So we are recording all the sessions for our attendees, and we will be posting them on our website. And thanks for participating. We really had a great day. Thank you.
Thank you.
Thanks for having us. We appreciate
your attention. Thank you, everyone.
Thank you.
Thank you.